Hello, welcome back to the May market update. Tony Marlette Jr. at Brookside Financial Group. Let's get right to it. So for April, for the first time in a while, we saw negative performance across all the major market sectors, down between 4% and 7% for the month. Remember, we typically see 3-5% drops per year in the market historically. So we've been really spoiled over the last few years. We really haven't seen that. So this negative performance in April in and of itself is nothing to be worried about. Part of why we did see that drop is because of the lingering effects of inflation. Inflation did decrease for a little bit, and then it kind of stubbornly stuck around. Remember, if inflation goes down, it doesn't mean the prices are going down necessarily. It just means that prices are not rising as fast as they once were, and we're still above long-term averages on inflation, and we're coming off of those 40-year highs. So as a result of this, we may not see the 6 to 7 rate cuts that we thought we might see from the Fed this year. We might be looking at between 1 and 2 for the rest of 2024. The ECI and the JOLTS report, which are both jobs reports that measure job openings, have both indicated that that part of the economy is starting to slow as well. The public sector, aka government jobs, is the only job sector that continues to rise. And we've mentioned this before, that government jobs appear to be propping up the entire job market. And I don't think it's ever been more evident than it is right now. Fortunately, though, business fundamentals still drive the economy. We're in the midst of earnings season now, and the vast majority of companies that have reported earnings have been positive. So if we do get a rate cut and you happen to be investing in bonds or bond funds, you could see a perfect mix of increased price performance from bonds, and then also yields should stay elevated as well. And the data does also show us that amongst all this, consumers are finally starting to adjust some spending downward, which is obviously a key indicator for the Fed. Having a safety net for your assets does not necessarily mean keeping your money in cash, earning nothing, and waiting on the government. Stocks are a bumpy ride, but over the long term, the benefits far outweigh the negatives. With interest rates coming down potentially, if you don't feel like waiting on the Fed for your safe assets, there are other alternatives. Remember, safe assets and growth assets each have a place in your portfolio. The key is finding a blend that is most consistent with your goals, strategy, and time frame. If you'd like to review your financial situation with us, feel free to do so. You can visit us on our website, our Facebook page, and our YouTube channel as well. Reference this video, and you can pick up a copy of one of our books in addition to your complimentary consultation. From all of us at Brookside, we thank you for working with us, and we look forward to continuing to work with you.